Hey everybody, new episode of the What's Your Why podcast is out now with Jacob Radke. Jacob is somebody I met over LinkedIn. I've been fascinated by the different content he puts out, whether it's market reports, whether it's content through their podcasts over at Fjell, or just seeing his daily posts. It's been fascinating to follow along with him so far, so I asked him to come on the podcast, and he agreed. Throughout the podcast, we talked through his journey into the finance world, why he creates content, how he creates content, and just kind of his why overall in life. So give it a listen. If you like it, share it. I appreciate you guys coming back to listen this week. And Jacob, thank you for coming on. Enjoy.
I wish I would have gone to the Van of Vans
That'd been
one.
cool.
That one probably would have been good. But like, there's other ones where it was just like maybe some restaurant or something.
Mm-hmm.
And I was like, all right, I kind of get how a restaurant works. Like, whatever. I don't know if I need to take time out of my morning to go.
Have you ever worked in a restaurant before? We are started, by the way.
Oh, okay.
So
No, I have.
It works. We're just gonna roll with it now.
All right. Well, no, I haven't ever worked in a restaurant.
It's a wild time.
I believe it. Like the restaurant game. Trying to I don't know. I can't even imagine what it'd be like to be like serving people, and I don't know. It just seems like it would be something I wouldn't be good at for sure. Because especially when you get like 100 people that come in, like can you imagine? I guess you can imagine because you worked in it. But like, if I'm like a server and all of a sudden 100 people show up at noon or whatever because it's lunchtime, and then you have to sit there and try to flutter your way through this thing, and then it happens again at 4:00 or something.
So you can, if you want to see it happen.
Yeah.
You have to go to I never dealt with that. Yeah, I worked at Red Lobster.
Okay. Yeah.
In 2 different locations.
So you worked at 2 different locations?
Yep. So I worked here for my undergrad. All through my undergrad, I worked at the Fargo Red Lobster, and then I worked at the Red Lobster in Columbus.
Okay. Yeah.
And that was like a high-end Red Lobster. It was right next to a really expensive shopping mall where they had Saks Fifth Avenue and Gucci and
if they have Gucci there, yeah.
Oh, what was the other? Tiffany and Company, and
okay.
North Face. It was like a very high end.
I did not know that they had like high end Red Lobster. I did not think luxury Red Lobster existed.
It wasn't really like a luxury Red Lobster. It's just a very well placed Red Lobster.
Okay, I see. So it's just around all the money, basically.
Exactly. Yeah, and so. There was 5 Red Lobsters in Columbus, and the average tipping percentage at that one was 19%, which is very high, in my opinion.
Yeah.
And I averaged around 24 to 26.
Dang,
and
that's pretty good.
If I got below 20, I was pretty upset, which was wild compared to Fargo, which was an average of 15 to 17, I would say.
Yeah.
And if you got 20%, I was really happy.
Yeah.
The tipping is just. The meal prices were almost the exact same between the two, maybe a little bit of inflation over the time I was working there, but tipping is much more accustomed in Columbus.
I guess I can kind of see that around here where you maybe don't get tipped so much. I don't know. My rule of thumb is I'm just maybe I'll if it were there for not that long, but whatever. It's it's generally always 20% flat. But then if I'm all right, I'm here for an hour and we kind of sat around and did everything, I'm going to think of this also as a paying you per hour type of tip, where it's I'm here for an hour. This is time that you don't get to sit here and make money off of other people because I'm not leaving. Yeah. So it's all right, I'm going to float you a little extra. If I sat here an extra 30 minutes, it's okay, I should give you an extra $10 at least, $20 an hour, plus my tip.
That's not a lot of people think that way.
Yeah.
I always think that, and this is what I was taught by my mom and my dad. They met working at Sports Bar in Old Broadway.
Okay, yeah, right there.
And my dad managed Sports Bar for 10 years. My mom was a server at Old Broadway. And so my sister also worked at Red Lobster for years with me as well. But $1 for every time they go get something for you.
That's
extra.
a good strategy too.
And then 20%. It works out to be pretty close to accurate if you just do 20%. But if you make them go get you a bunch of small things, then you should probably
give them a little extra
bit. Because just say this building's a restaurant,
right?
And this room, I have 4 tables in this room, and you want a ranch and the kitchen's upstairs,
and you have to,
and that's like 3-4 minutes
yeah,
for your ranch
for just a cup of ranch.
Yeah. But like the Fargo Red Lobster, if you're like put out in the red room, we called it. It's like if you've ever been there, it's the window closest to like Target.
Okay.
It's like a 2-minute walk. If you're going straight out, straight back, walking fast.
Wow.
And so, but if you have to get a bunch of stuff, like your table's back there, it could take. There's desserts, like say a whole table gets a full thing of desserts, and
you can't like bring it all out even at one time,
Yeah, and say you have a 4 top, nothing crazy.
Yeah.
But they all order a dessert that takes 2 minutes to prep, and you only do 2 at a time, so that's a minimum, like a minute walk.
It gets to like,
and then 5 minutes of prep time because it's not gonna be instant.
Right.
And then you have to microwave it. It's a minimum of like 8 minutes, probably, or 6 minutes.
Dang.
When you think it's gonna in and out.
Yeah, that's just a weird way to think about time at a restaurant too. Like your server's time of like, like my minute that I make you go do something, like it adds up because if you have 4 tables, all of a sudden every 5 minutes, them getting like a cup of ranch.
You get so many steps. Yeah. Like,
do you want to hear? Okay, so you want to hear a funny story about a restaurant thing? So
just bring this a little bit closer to you.
We're Minnesotans, right?
Yeah.
And so they got the whole thing of like Minnesota nice, Midwest nice, stuff like that. We were going to visit my aunt in Colorado, and we stopped at this on the way back. We stopped at this like whatever, it might have been a Perkins, honestly, or no, it was like Village Inn, and like we just stopped there for lunch or whatever, and they do this thing of like customer of the week, like the nicest customer that comes in there and does all this stuff, whatever, like they get a free pie. And we're like, just casually doing it. We like didn't know that this existed. This is the first time we've ever been there. We didn't know anything else. And we're like, we paid our bill, we leave, like we're walking out to the car, and the waitress like comes running out, and she's like, I get to give one person a week like a free pie because they're the nicest client, or whatever. And we're all just like, what? Wait, what's going on now? And like we turn back and then like give us like a free pie, and it's like, how ironic is it that the Minnesota people are the ones that get the free pie, just the Midwest nice there.
No, it makes sense.
It's kind of hilarious. I was like,
you were talking about your like that mad rush of people coming in.
Yeah.
If you like, when I was early in undergrad, like I didn't drink at all or anything like that, but I always stayed up late watching movies.
Yeah.
And like Netflix binging like everybody else does. And then I loved going to Kroll's. And so I'd go to Kroll's at like 2 a.m. But you would see, and I always like the people watch back then.
Yeah.
And so you would just see a ton of people come in at 2 a.m. and be one server on a Kroll's.
And you know like exactly where they came from.
Walking in.
Yeah.
Oh yeah, you know exactly where they came from because they're sloppy. They can't move. And I always felt so bad for those servers because they're just getting destroyed. And usually there's like at least one sober person with them that's like trying to take care of their table. And
49
whatnot,
and then 1 or like maybe 5, whatever. Ooh,
pretty rough.
Can't be it.
So I know we're like almost 10 minutes in now. Who are you?
All right.
Why are you? Just who are you? Like, where are you from? I want to get into like the details.
The details of Jacob. So I grew up in northern. We were talking about this. Not exactly northern Minnesota, but central, north of Brainerd, Minnesota, right around Leech Lake area. I for the longest time, I really didn't know what I wanted to do with my life and stuff like that. Like I didn't really exactly know anything. I knew that I liked math. I was good at math. Like, all right, perfect. Like I can be an engineer then, right? Because if you're like math and you're good at math, like it's like natural. You're like, I can be an engineer. Well, I was taking all of these college classes, like our high school, surprisingly small high school was offering college classes like online, and the teachers or whatever were certified to do college classes. And, so I was able to take some of those. Like I was getting into like calculus, and I had done like AutoCAD and stuff like that, like very kind of engineer focused things. And then our school got this robotics program, and I was able to do that and instantly realized that I was terrible at engineering. And so that was like a wake up call for me. I was like, oh man, okay, well, what else can I do then? If I like math, I'm good at it, but I'm not good at like engineering, or maybe don't like engineering at the very least. Like, what can I do with it? And so I go home, and this is like a no joke. This will be a story that goes down in like history for me. I go home and I get on Google and I say, like, what do I do if I like math, but I don't want to be an engineer? And like, all right, Google spits out, like, the top one is like, be an accountant, right? Like, okay, perfect. That's very math focused. It's pretty much only math. And I was like, no, I don't think I want to be an accountant. And so, because they don't make any good movies about accountants, right?
That's
Besides
true.
maybe that one, The Accountant, I think that's a movie.
Yeah.
And then
He's an assassin, but.
Okay, well, I guess either way, they don't make any good movies about it. But they do make good movies about it is number 2, and that was finance, you know. So you think about finance and it's like, oh, okay, perfect. Well, I can be like wearing a suit, walking down Wall Street. Like, that sounds awesome. All right, that could be a cool gig.
Wait, hold on a second. So we're currently at your work. What's your current outfit for people not watching the podcast? Are you wearing the suit?
Yeah, no, and there is no suit on me right now. I've got this, like, I don't know, quarter zip, like, whatever sweatshirt type deal. Yeah. I've got jeans on, blue jeans, and I've got Merrill, like, boots on. So let me tell you, the transition from thinking I was going to be for somebody that wore suits walking down Wall Street to hitting reality switched very fast. I think I have worn a suit maybe, like, I don't even know, 10 times in my life. Mm-hmm. It was to take my headshots in college. I, like, wore it to job interviews. I wore it to this job interview, which, like, was actually kind of shocking. So I work at Fjell. I remember interviewing as an intern, and I walked in, and you saw how all these other guys dressed too. Like, we're all very chill. Walk in this, like, full suit. I'm like, oh man, I'm way overdressed. But I still, whatever, it's still the same thing. And then the next interview, so the second round of interviews, I come in and I'm like, I'm going to be super casual now. Like, I'm literally just going to be like regular old me. And Tom looks at me and he's like, Jacob, why didn't you wear the suit today? And I was like, well, because last time you all looked like, not like me. So I was like, I'm going to get on the same playing field here. And so I don't know, maybe he liked that, maybe he didn't, but I was like, this is,
well, you got the job.
I did get the job.
Was it a competitive application?
Tom says it was competitive. I don't really know. I wasn't obviously the one on the hiring side of things, but he said that there was a lot of good applicants. So I don't know. I must have wowed him with something.
There you go.
And then, so literally a year later, I got hired on full time. So then I had to go and take, you know, the regular old test to get your licenses. You know, so I'm a broker dealer. I guess I'm a registered representative of a broker dealer.
There you go.
I can't be a broker dealer. That's a business. And then I'm a investment advisor representative. And so you had to take these tests and get all that stuff. But that was about a 4-month process.
So I interrupted you, like, part way through, you know, obviously to talk about the outfit. That's the important thing.
Yeah, and then I rambled on.
Where did, when you were realizing that you wanted to be, like, in the finance world, right?
Yeah.
What was your thought process going into that?
It was really the thought process from, like, high school and kind of just figuring out it initially. Mm-hmm. Yeah, it was literally just that I liked math.
Okay.
And then I just, so this is also interesting. And I really found my calling later in college where it was like, okay, perfect. I kind of know what I want to do. Mm-hmm. And so I went to NDSU, so right here in Fargo, and it was interesting. I applied right after I Google searched what I wanted to do. Mm-hmm. So I was like, oh, I'll just go to NDSU then, right? So I literally applied, got accepted, and then committed basically the same time. I had never been to NDSU. Like, I'd never even looked at another college campus besides, like, Bemidji State University and stuff like that. I've seen, like, the regular, like, community colleges and that one. Yeah. And then, so I went to NDSU for Discover Day and getting, like, whatever. And then the other one was, like, the, well, it would have been that when you register for classes the first time. And yeah, let me tell you, that was probably not the best decision. Like, I probably should have looked around a little bit more, but it worked out pretty well in the end. And so I remember sitting down with my college advisor, like, day one type stuff. And he was like, well, if you're going to be a finance major, you need to go into the Bison Fund. It's just like a student-run equity investment fund type deal. I was like, okay, perfect. Like, I don't know if I want to do this or not. Like, this is probably a good thing to do, similar as robotics, where I learn really quick whether I can do it or not, or should do it or not. And it was hard because you're in there with a bunch of seniors that know all about this, like, analyzing businesses and stuff like that. And I remember being the freshman that I was, like knowing virtually nothing. Like, okay, I know what revenue is and I know what all that stuff is, but like nothing about anything else. So I had done that and I stuck with it. And then I started taking, so all of this, I came in with like 2 semesters two semesters under my belt.
Okay.
And so I was like a sophomore. So I started taking like my actual finance classes into like my 3rd semester and 4th semester. Like I was starting to get into those kind of things. The only problem with it is that I was immediately sent home for COVID. So
okay, so this is
what
like, year did you graduate?
Flash forward, college?
Yeah.
2021, December, almost exactly a year ago.
Okay.
Which is kind of crazy because I am 21.
Yeah.
Like full and fair disclosure. It's one of the most interesting things when people ask me how old I am, because usually they're like, oh, he's probably like 24, like 25.
Yeah, Tommy told me you're 24.
And he did?
Yeah.
Okay, well, he's wrong.
So he's wrong.
Tommy, when you listen to this, you're wrong. I'm 21.
I doubt he's listening to my podcast.
Oh, well, rip. All right, well, I'll just send him the clip then.
Yeah,
and then
exactly.
Be like, all right, Tommy.
So you graduated high school in what year?
2019.
2019, graduated in 2 years, but you were taking college classes.
I took college classes in high school, and I did 20 credit semesters. So
okay, yeah, so that's perfect.
Gets you.
I don't think college is what I went through. I was an education major. I know a lot of our classes can be fairly easy. They're more of, you have to be more of a creative person to be an education major, in my opinion, than you have, because like somebody who's very analytical and probably your average engineering student wouldn't thrive in an education course. But I didn't find it very challenging. I took 20, 21 credit semesters as well. It's the way to go. It's you get it done way faster. Yeah, and it's cheaper.
And very much so cheaper. NDSU is not cheap.
No.
I mean, it's cheap compared to
comparatively.
Yeah, comparatively, but not comparatively. I've still looked at it as like this massive bill.
Exactly. I looked at. I remember looking at Ohio State, because I was an Ohio State fan when I was really young.
The Buckeyes.
Yeah, I was a big Buckeyes fan. My dad was like, "Who are you gonna cheer for in this game?" It was LSU versus Ohio State in the national championship. Like now, it's probably 15 to 20 years ago, and I was like, "I'll cheer for the red team." Come to find out, it's Crimson, but no, not Crimson, Scarlet. If any of my
red's close enough.
If any of my Ohio State friends hear this, they'll freak. But when I went to look at how much school was for them, and I was not very, like, my ACT score was low. It was 23. I was like, not getting in there.
Well, you were better than me. Full and fair disclosure, my ACT score was 21. So
I was 21. Then I got dropped down to a 20.
Oh, wow. Okay.
And then I got a 23.
I only took it one time.
Yeah.
I'll be honest, I did not study for it. So my 21, I was like, that's good enough to get into college. So
yeah, I was like, I got a 24. I was like, I'll get that. And then, nope.
It's like, why pay for it again was my thought. I was like, if I can get into the college I want with this score, it's like perfect.
Yeah. There's one scholarship for North Dakota that I had. It was like $2,500 a semester. So I really want that. And so I had to do this extra testing to get my 23 basically bumped up to a 24 in the eyes of the state. Yeah. And so it was working out.
Well, that was the dumb thing that I did, because I think if I would have gotten like even just one more point, like a 22, I could have got I think it was like only $1,000 or something a semester, but like still.
Hey, that's
for one
point,
$8,000, I should have done it, and I didn't do it.
Yeah. But no, it ended up working out, you know. But you're going through these classes. Are you thriving?
I'm thriving. So obviously finance is very analytical. It's a little bit of science and art thing, because there's a lot of science in like the math behind it. There's a lot of art in the feeling of it, you know, like you don't become the greatest hedge fund manager in the world only on math, right? You kind of have a gut feeling about things, and it's mainly just because the markets are collectively made up by, 7 billion people. Every single person on the planet like engages in the market. And so you have all these buyers and all these sellers, and if all of a sudden they throw your entire strategy out of the window and start selling totally against it, like that's obviously going to ruin you. And so like that's the weird thing about markets is like that's the art of it, is because there's no set rules. Like it's like, all right, every man for themselves. Like the market doesn't owe you nothing.
Yeah.
And so, but you have to know like the analytical side of like how institutions think about investing, right? And how financial advisors and how individual people actually think of investing, because that's where the money is going. So if all of the money, if the best investment in the world is Apple, and nobody thinks that Apple is a good investment, then Apple stock will not rise in value.
Yeah.
It's like one of those things that's like, okay, well, it's just all supply and demand. And so Apple's fundamentals, and they can grow revenue like 25% year over year. And if nobody wants it, it's not going to go.
So did you, the way you talk about it being like an art is fascinating to me.
Yeah.
I've been getting more into like artistic things. I'm not an artistic person myself. I just think they're cool. But I'm finding like the value in it to be cooler. When did you come to the realization that it was more of an art form?
It was after college.
Okay.
I'd say that because in college they teach you the analytical stuff.
Yeah.
Right. Like, I mean, Finance 101 is like, how do you value a bond? And bonds are very, very mathematical. Like, you get the bond because of the yield and the maturity. Like, that's literally how a bond is priced. And like the direction of the bond, like the intermediate part is the volatile part, but it'll always mature at par, whatever. So they'll teach you about that stuff. They teach you about, present value of future cash flows. Like they'll tell you about, just amortization, stuff like this. That's like Finance 101. And then you get into like more security selections type classes. So I remember like, I can't remember what exactly, financial analysis, I think is what the class was, like Finance 320. And we like get to build this stock portfolio, whatever, as the project. And you learn all about like, all right, how do you value a specific security? So that's like how you apply present value of future cash flows. Like how do you actually value based on a company's underlying like, cash flow or a bond's underlying cash flow. Like that's the same type of deal. And so that's where you're doing that more or less. So you take the entire semester, you start this thing knowing nothing. That's when you're like, okay, I guess I'll just buy AMC or something, right? Like that's usually how these college students at this stage, like, I don't think I was like that. I was like, all right, we're going to buy Apple because everybody should have Apple, right? If you have a stock portfolio, more than likely you have Apple. And so that's what I was really doing. But then like, you learn all this stuff going through the entire class, and then all of a sudden you get in the next class. It's like, all right, fixed income analysis, and you learn about like, all right, you get convexity in bonds and all that stuff. I won't bore you with that, but and then you get like international finance and how currencies work and how economies work and the economics of things. I'm a very big economics guy, macroeconomics, and then you get into like actual portfolio management, like how do you construct a portfolio for an individual person. And that's where it really gets into an art, because that's where you're trying to decide allocations and percentages. Like, all right, Jacob is a person, like, all right, he has these financial goals, right? He wants to get to 70 and he wants to retire with $1 million, whatever. How do you get him to contribute first? That's the hardest thing. Like, you actually have to put money into it to get there. And then how do you actually invest that to match the end goal? And so that's where risk and reward, that's actually a topic from like the 1970s. Like that wasn't a thing. Like if you were working with an investment advisor or whatever before 1970, it would have been completely different than how it is today, which is actually kind of interesting.
So before 1970, would it have mostly been how to spend your money?
It would have mostly been, it still would have been like stock and like, the actual market related stuff. I think it was a little bit more like broker business, where it wasn't an investment advisor that was advising you on your money, right? So you would talk to, because mutual funds weren't a thing until 1964 to 5 or something. So
describe a mutual fund.
Mutual fund is just like a wrapper of like stocks, bonds, whatever they are. It's just like basically it's this giant vehicle that if you buy one share of a mutual fund, you're buying, maybe half a share of something that has,
I feel like, so I'll describe it in my simpleton
go ahead.
Like you can buy a mutual fund into like gas companies.
Right. Yeah.
And then so you're buying partial stock into multiple gas companies. Would that be accurate to say?
That's exactly it. You buy one share of, and then you get it split out between everything else that the mutual fund company
I've seen
holds.
Wolf of Wall Street.
Yeah, that's
no,
right.
that's not it. But
no, so yeah, they weren't even a thing until 1964, and so diversified portfolios weren't exactly a thing. Most of the time, you'd call up your broker. So a broker isn't even a fiduciary. Like, we're fiduciaries. We're going to act in the best interest of our clients. And brokers are just like, they pick up the phone. So you said Wolf of Wall Street. He was a broker, right?
Yep.
So he would call people, or people would call him. He would make money on the trade, not on the advising. So
okay.
people would say, okay, I want to buy a block, and a block is 100 shares. You couldn't buy shares at less than 100 before, whatever. Like, now you can buy a fractional share, which is kind of crazy. You say, I want to buy a block of, it wouldn't have been Apple at the time. Like, I want to buy a block of that energy company.
Ford.
Whatever, Ford. There you go. That's a good one, Ford. And so they'll route the trade. They'll literally mail you the stock certificate, and it'll get to your house in like 14 days. And so then these guys came around that are, I think it was Fama and French, and they came up with like the modern portfolio theory.
Okay.
And so modern portfolio theory basically is just like, you are going to build a portfolio of stocks and bonds that match a risk return goal. So it's basically just like, how much volatility do you want to take? Like, how much ups and downs can you handle, or how much ups and downs can your plan handle? So older people, ups and downs are a bad thing, because if you're, using your distributions, like, you're like, all right, I got to afford to live, and you're an old person, the stock market's down 40%, that's a bad thing, because you're pulling money out at 50% of its value. And so that's, I don't know how I got on that tangent. Portfolio management class.
Well, you ultimately went down a tangent from kind of like how you were doing in school. Pulling you back and like, where do you like or not? And it sound and talking about the art of it a little bit. That
was it. I took computational economics.
Okay.
I took econometrics, and I took portfolio management all at the same time. These are like the three probably hardest classes I've ever taken in my college time. Like, and then it was like I blended these together. So in computational economics, we like learned, it's a lot of Python, like actual coding type stuff on economic data. So economic data analysis using Python, which is wild anyway. But you had like a project that at the end you could do whatever you want. So I basically just said, okay, well, I'm just going to merge my portfolio management project with my computational economics like project, and then filter in a little bit of econometrics. Econometrics is just economic statistics, is whatever.
Okay. Yeah.
And so you're like, all right, so I can build optimal risk reward profiles out of a mix of stocks. So basically what I did in this project is I took like, I am going to invest in like whatever. I'm just going to Apple, Tesla, blah, 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 blah. You're going to build like a whole portfolio of things. You just download all of that data, and then you have this simulation that runs it 10,000 ways. And then you have a 10,000 portfolio sitting in front of you, and then it calculates the returns over like whatever, an annualized period. And then you find out which of those is the actual optimal one. So that was like my whole project. And then I was really just like, okay, now how do you actually do security selection within that to find a better one? Like, if you dropped IBM entirely and replaced it with whatever, how does the risk return profile change? And so I blended those together. And that's part of the art of it a little bit. Like, it's very analytical, very arty.
Gotcha.
Yeah.
Okay.
The visualization of things.
Gotcha.
Yeah.
Makes sense. Some of it went over my head.
Well, that's all right, because
some of it was definitely graphs.
I think even in that class, it went over people's heads.
Okay.
So yeah.
So I want to. There's a few things I want to cover, and one of them is when you're looking to further your education beyond college, and which it seems like you have.
Yeah.
Significantly, because you develop these thought processes and these
Right.
ideas about finance and money since then, and trading, it sounds like. Where do you go, and how do you, because there's so much information out there about money, about finances. Where do you go to learn, and how do you know what to keep
and throw away, right?
Yeah.
Like what's the garbage and what's
what do you
not
let
garbage?
into your brain, and what do you not let out, or what do you like just let go through?
There's about nothing that I won't let go through.
Okay.
Like I'm open to anything, especially because even the contrarian take like is a good take, right? And so I read, obviously you get the basics, like you have like the Wall Street Journal, you have the Barron's, and you have CNBC, and you have all these like actual financial news websites that just post out like current event stuff. But the really great thing, and this is something that I've even started, is you just have these guys that run institutional money, run money for their clients, whatever, that they write their own blogs on their own thoughts. And so it's like an individual person that's just writing blogs. So I like, if you think of a great one, that's like Ritholtz Wealth Management, all of their guys there, like you have Ben Carlson, and he writes A Wealth of Common Sense. And you have Michael Batnick, and he writes The Irrelevant Investor. You have Josh Brown, he writes The Reform Broker, and they write all these things on like whatever, market history, current events, stuff like that. And they just they write in this way that it's like it's very interesting, and it's a lot different than, it's a different world than just reading CNBC, because they're not there to get clicks, more or less. Like CNBC is like driving you there to get your eyeballs to click on an ad. And these guys are like, they have ads on there, in full and fair disclosure, but they are there to inform you in a different way than CNBC is. So I get a lot of research from that too. And so that's like the places that actual like people can go to, like a lot of blogs. And so I have my own blog I write at, and I actually just built my website, runningthetape.com. And so like I try to like publishing content on there, like literally, I don't even know. In October, I started it on Substack, which is just like a platform for writing. And then I transitioned. I was like, I'm just going to build my own website because that's what I want to do. And so I did that. But so I have all that going for me. And let me tell you how beneficial it is to actually write in understanding something. And so like if you're just constantly writing about something, it's just so much easier to understand that topic. And then obviously I also, so in furthering just whatever education and stuff like that, I have access to all the institutional research. So when
through your academic history,
no, just because I'm an investment advisor, so I have access to like Goldman Sachs research. I have access to JP Morgan research, and there's some other ones there, but like Schwab gives us a bunch of it, and I don't have access to Bank of America yet, but someday. And so a lot of those places, they put out like the portfolio managers write pieces on whatever. And
okay, so that brings me to, I want to come back to some other points that you just talked through.
Yeah.
But I'm listening to this book right now. It's my sister recommended me something about being rich. I don't know. But so far everything seems sounding valid. Nothing ridiculous yet. But he talks about how a lot of big banks will put out information that ultimately will kind of harm their users, or is more or less put out for, maybe not harm them, but the average user is going to misuse it, so the bank ends up making a lot of money.
Right.
Do you think that the information coming from like Bank of America is going to be skewed, or what do you think?
It depends on what information you're looking at. Like coming right from a portfolio manager, probably not, because they're going to be focused on their individual fund, and they're like, the job of that portfolio manager is to collect more assets. So his benefit is in bringing more assets to himself, which I guess you could say whatever, but more or less, I think you're talking about the general retail communications, right?
Yeah.
So just regular people that can go on Bank of America's website and see their insights. I know Tom has talked about this. So they worked at UBS right here in Fargo before they transitioned out and started their own RIA. So that's what the Fjell Capital is we're just independent investment advisors. So UBS used to try to get Tom and whatever the other advisors to sell credit cards to their clients. And so obviously, as an advisor, you're not exactly, it's not exactly in their best interest to put them more in debt with the company that you work for's credit cards, right?
Yeah.
And so there is definitely tactics where the banks are trying to get you, because they make money obviously on
debt.
They make money on debt. Yeah, they're trying to get you to pay them. And the way that they get paid is by interest payments, or they get paid by you putting your deposits there, and then they lend it out, right?
Yeah.
And so that's their motive. Yeah. There's definitely some content that is trying to do it. The other thing I will say is even if content isn't necessarily targeted towards making people make bad decisions, like most content probably isn't geared to that.
Mm-hmm.
It's how people take the content that's created and actually use it in their life.
Yeah.
So like, for instance, say Bank of America puts out a piece that's like international investing is back. And they put all these charts and it's very compelling. Like, okay, perfect. International investing obviously is the thing to do because Bank of America released this thing. I think I'll shift my entire portfolio into Bank of America or into like international stocks. Okay, that's obviously not a good idea, more than likely for you. And it's one of those things where it's like they don't fully explain like how to actually implement it. And so that's where it's more dangerous. It's like, okay, international maybe should only take up 10% of your assets and not 20, not 30, not 5, not 100. Who's to say like you can decide that on your own? But that's how things get harmful to people, is they're too concentrated, under diversified. They put too much trust in what they're reading type of stuff.
Okay. Now that made me think of that because I literally thought of it on the way over here.
Yeah.
I was like, and I heard him talk through it in the audiobook. But so going back to learning and continuing education past school now and in your current role and posting, and I completely agree with you. Writing stuff makes you think about it so much more. And probably a lot of the thoughts I say in here are probably pretty dumb, but when I put out like my
I mean, hey, it's all good.
Yeah, any of my educational posts, I'm a big education guy.
Yeah.
Everything I like to do is about learning and development, kind of.
Right.
And so a lot of what I write on LinkedIn is something I go in and spend a lot of time looking at. And like my thesis topic from grad school is something I know so much about because you're forced to know.
What was it?
So what I wrote about was what teachers who also coach a sport in high school learn and use in their classroom that they get solely because they coach a sport.
The team effort type
and
deal.
Then the inverse as well was included. What does a coach use that they learn in the classroom that is better used to help them coach their sport?
It's an interesting thesis.
I found it fascinating because my whole life has been a bridge between athletics and because my dad was our phy ed coach. So we were in the weight room every morning at 6 a.m. since as long as I can remember.
Right.
I didn't always lift, but like that was just, we rode with Dad to the weight room. And so I grew up around that, but then fell hard into FFA my 8th grade year of high school.
And what's FFA?
Future Farmers of America.
Oh, okay, yeah.
And so you've probably heard of the acronym if you don't know what it is a little bit. But it's very centered on education of all students in the world of agriculture.
Okay.
But it's such a broad term now. Like, it stands for Future Farmers of America, but there's so much more to agriculture than farming.
Yeah.
Like, there's everything from
finance, commodities,
exactly, to like biotechnology, to microbiology.
Yep.
And so I kind of loved the organization because I was like, it's education for everyone.
Literally.
And so that's originally what I went for. But I bridged my two passions of education and sports with my thesis. And there was not a lot of research into that bridge because there's like the journals for sports and coaching are very skewed. Because it's a big money industry where like the researchers, in my opinion, are paid off not publish the most accurate data. Kind of like there's a recent thing posted about like a new government approved food pyramid that puts eggs below Lucky Charms.
Oh, I've heard of this.
Value. Yeah. And so there's a lot of like mistrust. And I originally learned about the mistrust when I started in CrossFit because they they have their own academic journal because the National Strength and Conditioning Association, NSCA, is terribly bought by these big brands.
Right,
and
like
so
General Mills just goes in and says,
exactly,
I'll give you $1 million.
Exactly, to not post this, to not publish this data.
Put Lucky Charms at the top.
Yeah, or to say that this exercise technique is not the best when it definitely is. Or you see the president of the NSCA and the different representatives throughout the whole organization. It's a company based on the research of exercise and fitness and performance. Yeah. And these people are extremely overweight.
Oh, wow. Interesting. Yeah,
and it's like, how can you be the spokesperson for like health and fitness?
Right.
And so like there's a lot of like fraud to the.
That actually brings up an interesting thing. So I read this book called Fooled by the Winners.
Okay.
And so in this book, there was this one part that was on like drug companies and how because they're the ones that they publish a ton of research. Obviously, they're drug companies, and one drug maybe goes through trial phases and research, 100 times, and it's only one of those times that it's approved. And so, you have all these things, and basically the whole premise of the thing is like, okay, one person succeeds, and everybody's like, this is a possible thing now, right? So we can go and do that. So I just thought it was an interesting thing because the main thing was that like, just because a drug is approved doesn't mean it always worked type of deal, where it's almost like, okay, just because like the NSCA, right? Is that right? Yeah, approves that like Lucky Charms are nutritional doesn't they maybe have evidence that says yes, Lucky Charms are beneficial because of this, but maybe it went through trials 90 times before it actually got to a conclusion, like that type of deal.
Well, the thing is, you can say, and you could easily say, Lucky Charms are a great source of energy, for a long extreme cardio,
right?
You
got sugar.
You
carbs,
need it breaks down so easily. Yeah, they're so light, they're so fluffy. Yeah, it's for somebody doing like an ultra marathon, it's not going to upset their stomach, right? And so they're like, it's great for you, right? But at the same time, there's other things that are healthier, better sources of that. Right, take an apple. It's a simple sugar, and it does the same thing, but
you got the research to back it up.
Yeah. But kind of where I was going with that was with like the continuing education. Yeah. Was in your role, Tom is he's like the owner. Okay. Yeah. Does he encourage you to like go out and learn?
Oh yeah, hands down. That's like, I mean, his whole thing is like, I want to offload my work as a founder to my employees, right? So instead of him being like, okay, I'm going to make all the asset management decisions and you're just going to execute on it. He's like, no, I want you to go find all the stuff. You're going to talk to the asset management people. So like literally 2 weeks ago, 3 weeks ago, whatever it was, like my guy from Goldman Sachs was here. My guy from JP Morgan was here. My guy from PGIM was here. Like all of these guys, they come in here and they tell me like, this is what other advisors are doing. This is what they're doing with our funds, right? They're obviously there to sell me. They're salesmen. And they come with a ton of research, right? Like JP Morgan has huge wings of research that they arm these people with.
They sell their data and they sell their research?
Basically, they give away their research and data in return for sales.
What are they selling to you?
So that'd be like a mutual fund and an ETF. Okay. Yeah. So so basically like in the mutual fund, this is one thing we didn't talk about back then. Yeah. You get charged asset management fees. So we charge asset management fees as an investment advisor. So like ours, whatever it is, it's like 1% most of the time. And it's variable.
You have to make money.
You got to make money. And so these mutual funds, so let's just say I, as an investment advisor, put my client into mutual fund X. So I charge 1%. The mutual fund charges 1%. All of a sudden it's 2% now. So you still get charged. So when these guys come in, they're basically trying to get me as a client and then charge my clients, right? So that's what they're trying to do. They're salesmen. So
like say net profit of $100, they get 98. You guys get 1, they get 1.
Yeah, basically. Yeah, basically the client, if you got $100 in profit, yeah, we would get $1. They would get $1.
Okay.
Like we don't get charged. I have to say this too. We don't get charged on we don't earn money on performance. We earn money on the total number of assets that we manage. So if assets go up by 20%, we're going to make 20% more money because we have 20% more assets that we manage. So we can't charge performance fees.
Oh, okay.
If that makes sense. Yeah.
Interesting.
Yeah.
Is that like company thing or
that's industry wide? That's a regulation.
Oh, okay.
Yeah. I think hedge funds and like private issuers, there's certain ways around it. Like hedge funds, they can charge performance fees. Like venture capital and private equity funds can charge performance fees. But it's all because they go through, like, you have to be an accredited investor to get into those funds. You have to have like $1 million in minimums to get into those, sometimes $1 billion minimums and stuff like that.
Whoa.
So yeah, those are like, all right, you really know what you're doing. You have a ton of money, and
that seems like a modern day Wolf of Wall Street kind of thing.
That's where the system gets a little bit rigged, right?
Okay.
Like I actually wrote a post about this because like you look at like the IPO price of Apple, whatever, it IPO'd at like, you know, maybe 200 million, which at the time is a lot. Like 200 million is a lot to IPO for. And then you see like news headlines about SpaceX getting a $130 billion valuation and OpenAI having a $29 billion valuation. Those are high valuations that were all captured in private markets, which are only available to those people that have $1 million of a, you know, $10 million portfolio to put towards it. And so like you really get skewed to like the people that are and so I looked at the returns of Apple from their IPO to a $137 billion valuation. That was like half of the return. So that return would have been like 10,000%, and then you got like maybe 2,000% after that. Yeah. Same thing with Microsoft, the exact same scenario. Same thing with Amazon. Same thing with Google. Okay. All these companies that IPO'd before they were $137 billion. All of the really, really, really high returns are captured in private markets, which for a good reason too, because private markets just aren't as volatile because they're not valued as often. But that's like the case of like, all right, more people like me should be able to get into this, because if SpaceX is gonna just go be private for their entire life, and I'm not going to reap the rewards from that, and only the ultra rich or whatever are going to get in there, the institutions and the insurance companies and the endowments and whatever.
So you also talked about your website. That's and so it is it kind of a way, two-part question, is it kind of a way for you to take what you are learning and thoughts that you're developing, ideas you're developing, and putting them out there to the world?
That's literally it. It's literally a way for me to like, all right, I just sat down with all of these asset management people. I can't just like let it sit in my brain and then forget about it in a day, right? Like, okay, I'm going to write this down, and now I need a conduit to share it with people, right? So the website is just like the vehicle that gets it to other people. Okay. So like whatever, I'm like, all right, this is a good thing for me. This is a good thing for other people. Like I have access to knowledge that normal people don't, and I hopefully am going through a way of relaying that to people where they're not like the Bank of America thing that I made earlier, where like, oh yeah, international is the only thing to do. I usually try to like filter in like, granted, this doesn't mean that you should only do that. You know, this is something that you should consider or talk to your investment advisor about.
Don't take any advice from this podcast. Take advice. Right. You can contact Jake.
Yeah, you can
Jacob
just talk
if you
to
want
me.
to.
That's the biggest thing. Well, and actually, I'll have to get a copy of a transcript or something so I can submit it to compliance before you publish it, which is kind of I didn't even warn you about that.
Hey, but, it's no worries.
Everything, they watch us like hawks. So, and for good reason, because there are people in our industry that were terrible.
Makes sense.
Right? Like, I mean, I literally just watched the Bernie Madoff series on Netflix.
Okay. I haven't seen that one yet.
You got to watch it. Like, if anybody's watched it, it's so good. And like, if you even know who Bernie Madoff is, do you know who Bernie Madoff is?
He ran a Ponzi scheme, correct?
He ran a Ponzi scheme. Yeah.
And so which one was it?
He did it in like, it was from 1998 to like 2008. So 2008 is what blew him up, right? So he promised 9% returns year over year, and like his performance chart was literally just a straight line up and to the right, which is impossible. That is never going to happen ever. And he was not registered as an investment advisor. He only was a broker dealer and a market maker. And so he had this like secret hedge fund investment advisory business that he somehow accumulated $40 or $50 billion. Some of that is returns because 9%, but he didn't actually make trades. He just like he actually hired software engineers to fabricate trades to validate to his clients that there was actual gains in the accounts. Basically how he did that is he would say, because obviously I can look back in history and say Apple from the beginning of the year to today returned this amount, right? So I can make a trade that says I bought Apple on the first day of the year and I sold Apple at its peak, right? Because it's after the fact. Yeah. So you can just go in there and say, okay, I made these trades. What ultimately ended up blowing him up, and this is similar to FTX, was the 2008 financial crisis caused this mass liquidity crunch, and everybody wanted their money in cash all at once. And so all of his clients called him up and said, hey, Bernie, we want our money. Like, everything's going to crap. And Bernie was like, no, you can't do that. At this point, there was $19 billion in principal, so just like whatever actual people had put in. And there was, whatever, 30-some billion in gains. So when everybody comes to you saying, I want my money back, and your actual balance is a gain, he only has maybe 19 billion in the bank. Yeah. And then you said Ponzi scheme. So obviously he didn't have 19 billion in the bank even, because he was giving dollars from one person to the next person that was trying to take out. So it was rough. It was one of those things. And Sam Bankman-Fried had the same issue because everybody in crypto wanted their money out all at one time. And boom, you blow up, because if you lost it all in your Alameda hedge fund, you don't have it to give back to them. And so you have to freeze withdrawals. And
that's rough.
Yeah, that is rough. And he will hopefully go to prison.
Yeah.
I don't remember how we got on that, but there you go.
I have no idea.
I don't know either.
We were talking about your website, and I do want to go back to it a little bit.
Oh, yeah.
And so sharing the information that you do through your website, do you see it as like a, because I asked you if you think of it as like a platform for sharing, and you do.
Yeah.
But what is the feedback like from that so far?
I mean, it's pretty new. It's only like 3 months new. I started in October, started on a different platform. The website was live. Literally, my Google Analytics doesn't go back, or it just recently went back 28 days. So the feedback isn't exactly high right now. I have like, I don't know, on my newsletter, so I have a newsletter there. It's a little bit easier to track the traffic. I've got like 63 people in it. Like not a lot, but I mean, that's a decent amount. Most of those came from Substack days. Yeah. And then just transferred over, but I've accumulated quite a bit more just on the actual website itself. A little bit better call to actions, I'll say that. Yeah. And so that's pretty good.
Are they your readers engaging with the material?
I mean, there's whatever. I'm not exactly a great at like the Google Analytics, like even SEO and stuff like that. But I mean, I don't really know what even event account is, an event, whatever on Google Analytics. But it said I had like almost 2,000. So
right on.
That's like, I think that's like page views, page scrolls, like clicks, all that stuff bundled into one. So one person could rack up just a ton of events. But at the same time, I mean, 2,000 events on a 60-person newsletter. I'm like, that's pretty good. I think that's all right.
For sure.
So it's going good. And I mean, I revamped the whole thing. I'm one of those people where I start something with the intention of finishing it later. Okay. Like I'm going to get this to the point where I can publish it and be good with it. And then I'm going to revise it later. Yeah. So I created the website, and it was trash. Like I literally had to go through Webflow University and like, I need to figure out how I can actually do it. And so I did all that. I got it, and I like looked at it. I was like, man, now, because I had gone through more of the courses in Webflow University and everything. I'm like, it just really doesn't look good. I think it can be better. So I was like, I'm going to boost up the user experience. I'm going to play around with more animations. I'm going to play around with like better, like, trying to use cookies, like all this type of stuff, like making stuff like actually feel like it's more alive on the page rather than just like flat nothingness. And the only thing that changes is the shape of your cursor. And so I got all that going. And so that was like it goes a lot faster. It's very exponential. My learning curve is exponential. It's I go one day, it's like, okay, my one day to the next day is nothing. And then the last day or yesterday to today is a lot like this huge gap.
Okay.
Yeah.
Right on.
And so Webflow is rocking and rolling.
There you go.
Yeah.
Do you have a goal with that, or just kind of continue?
Basically
right now?
the goal. I mean, at some point, like obviously, I would have to register like an OBA, an outside business activity, if I was going to do anything. I mean, at some point, I'll probably like turn on ads and make a little bit of money off of it. Like it just doesn't make sense for me now, especially. The other thing is actually complying with Google's ad rules is crazy hard. And so I just don't want to deal with that.
Okay.
So I'm kind of just like, all right, I just kind of want to get it for the views. Like, honestly, if people come from my website to Fjell Capital, like that's going to benefit me too. So it's one of those things where it's like, I have several cases where it's like, this can benefit me, this can benefit the people, everything like that. So we'll see.
You guys are very active in the podcasting world.
We are very active in the podcasting world.
So before we get started, you two were talking about how you have 3 going right now.
Well, 2 and one on the
way.
Yeah.
Okay.
Yeah.
I wouldn't spoil anything.
Yeah.
But we didn't say a title, so we're good. The other 2, you seem to be pretty active in them.
Yeah. So the one is happy with money, and so that one's kind of Tom's only. It's only him on that one. It's basically kind of like your podcast. Honestly, it's literally just like he sits down with people, talks to them. It's instead of what's your why, it's are you happy with money type of deal. Like how have you become happy with money? Like what have you done with you and your family? Like whatever. Like, and honestly, that can be spending. Like I went to Disneyland and I was happy because I got to spend time with my kids, right? Like that's being happy with your money. This is interesting. Money is a realization of value. And so or value is the realization of spent money. And so like that's his one podcast, and that was pretty good. Like that one's kind of cooking along. It's been going for, I don't even know how many episodes they got out. It's got to be, I think it started last year around this time as like an idea.
Okay. And
then it would have been until like April where it actually started like recording,
okay,
practice sessions, and then it would have probably been like May when it was actually released for the first time.
Okay, so it's the same age as this one.
Yeah.
So.
Yeah, and then Laminate Money is the one, I think we're literally going to record episode 18 on Monday.
Yeah, you guys have been very consistent with that one, it seems like.
Yeah, that one's, I mean, and that one, I'll be honest with you, that one's pretty much all me because like we go into this thing and I'm like, all right, it's going to be a podcast about like, you know, markets and investing and stuff like that. And you have like Tom is an advisor. I'm an advisor. I'm more on like research and execution of that sort of stuff where he's kind of like, I actually know the plumbing of like planning and stuff like that. And then Carissa, she's great at asking questions. Like she has an interesting perspective because she was like a coach, like a CEO, like she coached CEOs and stuff like that.
Oh, wild.
And so she kind of has an interesting angle on things. And so that's what that show is all about. I write up the Laminate Money show notes and go through all these articles because I read all of these things all the time. And so it's kind of easy for me. I just kind of copy and paste in all the stuff. And then we just talk about it and throw in whatever XYZ stuff. And we record it right here every Monday morning.
Well, I'm happy to use the studio.
It's
very nice.
And if you, this is interesting. So the only thing that was here before was the maple, whatever you call
paneling.
It. Yeah, the paneling, and all of this stuff. Like if you go back to our YouTube channel on like Laminate Money on YouTube, and you go back to the first episode, this is the only thing that we had. It was this and the paneling.
So it looked on. I expected this to be in a room, like next to. Like outside view, is what it looks like on especially the first episodes of Tom's podcast. It really looks like it's outside lighting, coming in on the wood paneling.
Well, that's good because it was definitely basement vibes when we started like shooting the 3-person perspective. Like it was basement vibes all the way with only having this light because the person sitting here, so this is where I sit, like you just don't get quite as much the same lighting as the person sitting there. So then we got these, we got this, we got these like, you know, LED lights here. Yeah. And if you go back on the timeline of like Laminate Money, you'll see like, okay, this shows up. And then all of a sudden sound panels in the corners only, these big ones in the corners show up. And then all of a sudden all of these things show up. And then you start seeing colors in the background that aren't what they used to be. And it was these things were never here. So
It
like
looks good.
The sound used to be just awful because like if you like know anything about sound, like
Mhm.
I didn't know anything about sound, but me talking here would bounce off that wall and bounce off that wall back to the mic or whatever. So it was awful.
I recorded one episode in a random gymnasium on UND's campus.
Okay, yeah.
And halfway through the episode, a paddleboard. Paddleboard. Like tournament started up in this random gymnasium.
Oh, well, that's terrible. Wow.
But it was such a faint audio that it worked out fine.
Yeah.
And like the padding on the microphones made it work. And so it ended up working out just fine.
Yeah.
But that's probably my jankiest podcast.
Yeah, because all you can hear in the background.
Very, very little. But like, just picture a very old stadium.
Yeah.
Have you ever been to Concordia's indoor track?
I haven't.
By chance?
There,
Okay.
no.
Let's see here. Have you ever been to a gym where it kind of like drops down like an arena, where like the court is lower and there's a balcony of bleachers?
So I mean, the Fargo like
Civic Center.
Civic Center.
Exactly.
Yeah.
Exactly like that. I don't know why I didn't think of that, because that was the picture I had in my head.
I literally haven't seen the Civic Center since I voted,
there
ever
you go.
before it or after it. So
yeah, I've been there tons of times.
Yeah.
But so it was just like that, and we're just up in the bleachers, leaning against the bleacher behind us, recording this podcast, and it was so janky, but it was so good.
Yeah.
But I'm sure we'll have something.
It's like a vibe
sketchier
right
than that.
Yeah.
Yeah. So I'm looking at building a podcast studio, ideally this week, actually. So that's why I said I didn't know where for sure we were going to put it.
Yeah. Well, luckily Fjell Capital has a podcast, and
yeah, there we go.
We've got it all.
I'll just steal a key and come down here whenever you guys aren't recording.
Rolling. Yeah, we've got this whole mix board thing. Like we didn't set this up. So we had a guy. So Tom had this other company, Likely, which is just like promoting like financial wellness, like basically benefits to employees, financial wellness app. And that's what the Happy with Money started on. And so Ben, the guy that kind of like ran the Happy with Money podcast, he's the one that like organized all this stuff, like got it all set up initially. Like if you would have been here 2 weeks ago, this thing was a pig pen because Ben left like in the summer. Okay. And so it was just awful. And I was like, all right, I've got to actually come down here and like fix it because it was looking so jank that you couldn't even find the chords that you were trying to deal with. And oh man, if there's anything I don't know anything about, it's like, it's this.
Well, you saw me struggle to get the mic started on this.
So well,
I don't know much either.
That's all right. Well, this like even this, it's like, okay, I guess I get it. It's just, plug in the USB-Cs into
their
your computer.
system does look pretty complicated, I'll be honest.
This is like, you got this whole board and there's dials and stuff on there, and you got all this podcast, like the mic things going into it.
They have a full audio soundboard. I have 2 mics plugged into a laptop.
Yeah, and so like when Ben was trying to show me this, I was just not having it. I could not. It was so rough. Yeah. Anyway,
do you guys have full plans like of keeping these podcasts going for a long time?
This is probably going to be a forever thing. Okay. So the it's lead gen. It's actually a pretty good lead gen tool too. The Happy with Money podcast has been pretty successful, and actually, like, we've actually gotten clients out of the Happy with Money podcast, which is pretty interesting. I mean, I don't think Tom would have ever expected that was going to generate Fjell, clients. But it generated Fjell clients before it was even a Fjell podcast. It was a Likely
what
podcast.
Was his original intention with the
Happy
podcast?
with Money was just going to be content for the app.
Okay.
And so then it was like now they're kind of like a little bit, I don't want to say dead in the water, but they're just kind of like, it's slowing down. Like the startup space is like, you can't raise money. It's hard to raise money. That banks won't lend money, stuff like that. So they're kind of like waiting her out and trying to figure it out that way. And so Tom's like, well, we don't really have a conduit, like a place to put it, but it's like all throughout Likely's existence, Happy with Money was benefiting Fjell. So he's like, I'll just spin it into Fjell then. Like everybody always already kind of thinks that Happy with Money is a Fjell podcast.
But it was a Tom
the entire time. It was a Likely podcast.
Okay.
And so that one has been going on, and it's like super good. And the Laminate Money one, let me tell you what I never would have expected in our time of podcasting. I don't know if you've gotten this, but like we, at the end of every episode, it's like, hey, if you got questions, like feedback, like whatever, like email us at laminatemoneypodcast@fjellcapital.com. Huge URL or like email, whatever, but whatever. We've gotten maybe 6 or 7 people that have like actually sent us an email, and it's not like, hey, great podcast, love it, period.
Yep.
It's like this probably like 500 to 1,000 word like email saying like, this is what I like, this is what I think you guys can do better. Like, here's questions I have about like stuff that you kind of talked about. I'm like, no way. And it's not like 1 for 6. It's like 6 for 6. Every single person that has emailed us has been like super like detailed in what they liked and what they like thought could be better. I thought that was, and we're only on episode 17. I was like, I didn't expect that we were going to get anybody emailing us at all, period. Like, that was my assumption. I was like, nobody's going to email us. Like, that's not what people do. Like, we're not going to be able to spew out this email address and people are going to pick it up and say, I'm going to take time out of my day and email these people about a podcast. But it happened and kind of surprised me.
I don't get a lot of that because I've never like put that out there. How can I make the podcast better? Granted, I'm completely open to it. If you get to this far in the episode, please either in my Instagram DMs or LinkedIn DMs or on Facebook, let me know. If you have my phone number, text me. Ways to make it better. But I get a lot of people saying, you need this person on, you need this person on, you need this person on.
Oh, there you go, yeah.
And I've also got a lot of you're sexist. So.
Oh, okay. Well,
but I do. It was not for a lack of trying. There's several women I try to get on the podcast, but either like they didn't see my reach out or they just didn't want to be on it. But my last guest was, or second to last guest, was Izzy. And that was a great episode. Super happy about the way it turned out. And actually Thursday's podcast will be another lady, which I'm super excited for.
Well, I think one of the benefits of you being called sexist is that you actually have a female audience. Right. That means that you have a female audience, and it's not only men, because if you look at our podcast analytics, the Happy with Money, I don't really know what that one looks like, but Laminate Money, 80% dudes.
Episodes go back and forth. It's very fluctuative on who the guest is.
Okay.
I had a guest that was from Miami, and it was a virtual one, and he's just kind of like a savage in terms of like working out and whatnot.
Okay, yeah.
And all bros. All bros. And so it's all just people, it was all just a bunch of guys looking about how can I like lift better. And it was funny, that podcast turned into like a lot about talking about weightlifting and training, but turned into him talking about a restaurant, which is like super dope.
Interesting, yeah.
It was a wild one. But I think we're at like just over an hour and 15 probably now.
Wow.
I don't want to take too much of your afternoon.
Yeah.
And I think coming back to talk about your articles you're putting out, your writings you're putting out in the future when it grows a little bit more, when you get your other podcasts even further down the road, I think it'd be awesome to have like multiple of you guys from your team on, because it's more than just like you might write a lot of the content, but it's more than just you on these podcasts.
And my perspective is a lot different than somebody else's perspective, because if you think our world is a bubble, we live in a bubble for sure.
For sure, yeah.
Like financial services, like we know so many things about like life more or less that like other people just don't exactly know, right?
Yeah.
Like there's just the math behind like buying a house, for instance, like it can get crazy complicated, and we learn about all that stuff. And so like Tom has often said this, I kind of am like, I agree, like we live in a huge bubble. Like Carissa will tell you that too, like she's not a financial person at all, like, and she's like, I rarely know what you guys are talking about. And so it's one of those things where it's like, okay, there are way different perspectives. And for me in particular, like I'm in like deep in asset management. Like I do our trading and our portfolios and stuff like that. Like that's where I live. And most people, 99% of people don't live anywhere near that.
Isn't that kind of crazy? Like you get outside of your bubble, and the world is so much different in somebody else's eyes.
And I mean, I think you could say the same thing. Like even you talking, I asked the question of what even was LTL shipping, right?
Oh yeah.
And because I've seen it a million times, but nobody has actually expanded on the abbreviation.
We probably did in our first post, talked about what LTL is.
Yeah.
It's less than truckload shipping.
Less than truckload.
But it's like the most competitive, maybe outside of car insurance salespeople.
Yeah.
But like, I talked to a guy yesterday. He's like, you are literally the 28th person to call from an LTL brokerage today.
Wow.
And I was like, wow, I'm sorry.
I'm glad I can be 28.
I'm 28, and why don't you give me a shot?
Yeah, no kidding.
And he was like, I think he's like, fuck off, get off.
Yeah.
But, and he hung up on me. But it's a very competitive industry. There's, like, what Rocket Shipping is, it's an agency. There's 17,000 agencies.
Of LTL. So is it
of
only
LTL brokerages.
So then, all right. I'm going to ask another dumb question. Now that I know it's less than truckload, is that like just like a UPS truck type of deal?
No, so anything you know of, it's UPS, that's small package.
Okay.
And then you'll see FedEx vehicles. Some will say ground, some will say freight.
Yeah.
Some will say a few different things, but it's FedEx is separated between ground and freight.
Yeah.
And anything freight is what we do.
Okay.
It's like palletized shipments. So, like, if you bought this table, this would be a palletized shipment.
And that would be LTL.
Most likely, yeah, it'd be LTL. If you bought any of this equipment on the table, it would come small package.
Okay.
So that's like two separate branches of
So if it
FedEx.
goes on the truck. So, yeah, that's interesting to me anyway, because less than truckload and it goes on a freight, like, truck.
Yep.
But
so
it obviously it can't fit on a small
think of it.
truck,
Just
right?
think of too big and bulky for somebody to carry.
Yeah. Well, dang. There you go. Well,
To put on to carry or to put on a simple dolly.
Yeah.
Yeah. Because if it can't go on a dolly, then it can't be a small package.
Right.
shipment.
Like the UPS driver is not gonna be able to carry it to the door.
Exactly.
Type of deal. Yeah.
And so there are companies like PRX. Are you familiar with PRX? Their equipment, exercise equipment, manufacturer out of Fargo here.
Okay.
And they push the limits. Like they have some pretty big boxes that they ship small package. But beyond that, it has to go via freight. So
interesting.
You think anything too big or bulky to carry.
Yeah. So then you said you're an agency. So you're an agency of
Priority One.
Priority One.
Rocket Ship is an agency of Priority One, massive company.
Yeah.
They do a ton of spend, so they get good rates.
Yeah.
And we sell those rates to our clients.
Oh, there you go.
And it's a very boring industry, in my opinion. But the cool thing, and like I'm sure you could say the same thing, so you probably think a lot of people find your job boring.
Oh,
but
hands down, everybody thinks it's boring.
If you know the niche pieces to it,
yeah,
and you develop this unique solution for somebody's supply chain that saves them $1.2 million when they were spending $3 million, that's a massive savings.
No kidding.
And like that's kind of stuff we do, which is really cool.
What I really like about like shipping and even railroads and stuff like moving materials from one place to another is the intricacy of that supply chain. Like you have to,
it's very complex,
like all the time know where something is, and like if something doesn't get from point A, like if my Amazon package doesn't get to my house in a day,
the tracking between Amazon and small package to what we do is so much different.
Right. But like you also just have to you have to move it efficiently, quickly, because otherwise you don't get business type of deal.
It is crazy the difference between tracking of a small package versus tracking of a freight package. It is insanely archaic in freight still.
Dang. Okay.
And
well,
so
there you go.
like to find out where, if anything happens weird with the shipment of a freight package, to find it is our team calling different terminals.
Oh wow.
To figure out where it is.
It's not like a QR code that tells you exactly where it's at.
If everything's going perfect, it is.
Okay.
No.
Dang.
It's interesting if you really get into the nitty-gritty.
Yeah.
But yeah.
I do. One of the most interesting things is the railroad the whatever, I can't remember what it was. I think I was listening to like some business analyst thing on Berkshire Hathaway, and they were talking about BNSF and how they didn't use something that was like precision rail technology to like efficiently make sure every single train, like mile of train track is being used at its fullest thing. I'm like, oh man, I can't even imagine what kind of a software engineer do you need to like develop a system that tracks it.
I can't imagine.
Wow, I don't know. That was like one of those things where it's like, if you, And the funny thing about that is they never let Amtrak or the like passenger train on their tracks because it's so inefficient. I
believe that.
Yeah,
I totally believe that.
And like getting people on a train.
And that's probably why it's so expensive.
Yeah.
To travel via Amtrak.
Yeah.
When it shouldn't be.
Because they don't have any tracks to travel on.
Yeah.
Type of deal. Yeah.
It's very limited.
Yeah.
But I do appreciate you coming on.
Hey, I mean, it was a great time.
Yeah, absolutely. And I want you to do a little plug about like the names of the things you're on, and then like the name of your journal, or not your journal, but like your website and whatnot.
All right. So we've got so many things here. So like I have a website, runningthetape.com. If you know what a ticker tape is, it's basically like if you look at even on CNBC, the thing that's moving around the bottom with the quotes on it. For sure. That's what a ticker tape is, and so that's kind of the reference. That's where I post all my blogs, stuff like that. You can subscribe to my newsletter there.
Okay.
I'm on the Laminate Money podcast, and so you can find that YouTube. That's where most people actually watch it, which is kind of interesting. But it's also on like Apple Podcasts or Spotify, Google Podcasts, Amazon, wherever you're listening to it. I'm not a host on the Happy with Money, but that's a great one to also listen to. Same story with that. It's everywhere. And then Fjell Capital. I work for a registered investment advisor. We're independent. We're not tied to a bank. We're not trying to sell like insurance products. We're not trying to sell like credit cards. We're not doing any of that. We're solely just planning and investment advice.
Right on.
And so, and we have a Odyssey service where it's just $125 a month. And you get all of the planning of a regular wealth manager without asset minimums. So
gotcha.
It's basically like the way to tap into people that need help but don't have minimums to get help. So that's the strategy.
Right on. That's cool.
Yeah.
Appreciate it. Thank you guys for listening once again. This was another great episode of the podcast, and the Fjell team, thank you for letting me use the studio with Jacob. It was an awesome time recording this episode, and then also just being able to check out and meet with the team beforehand. If you guys are excited for shirts, they're on the way. They have been ordered. So stay tuned for that announcement. And then everybody have a great rest of your week. I appreciate you coming on and listening to the podcast. Jacob, thanks for coming on. Everybody else, enjoy it. Enjoy the podcast. Give it a share. Follow the podcast on the channels, and have a great rest of your day. Peace.